Hey everyone, welcome back to the channel. Today, we're diving deep into a topic that might sound a little technical, but I promise, understanding it could make a huge difference in your investment journey, especially in today's fast-moving market. We're talking about portfolio rebalancing. Specifically, the big debate. Should you do it quarterly or annually, and why? Right now, the speed of your strategy really matters. So, what is rebalancing anyway? Let's keep it simple. Imagine you start with a plan. Say, 60% of your money in stocks and 40% in bonds. Over time, the market does its thing. Maybe your stocks have a fantastic run and now they make up 75% of your portfolio. Great news, right? Well, yes, but your portfolio is now riskier than you originally intended. Rebalancing is just the process of selling some of those high-flying stocks and buying more bonds to get back to your original 60/40 mix. It's like resetting your investment compass, making sure you stay on course with your risk tolerance and financial goals. It is a disciplined way to sell high and buy low without letting emotions get in the way. For a long time, the standard advice was to rebalance annually. Once a year, you check your portfolio, make your adjustments, and you're good to go. This approach is simple, requires less effort, and helps you avoid overreacting to short-term market noise. In a relatively stable, steadily rising market, annual rebalancing works just fine. It keeps your transaction costs and tax implications low, and it's easy to remember. Just pick a date, like your birthday or the start of the year, and make it a habit. For many years, this was the gold standard for long-term hands-off investors. But here's the thing. The world has changed. The market today is not your grandpa's market. We're living in an era of unprecedented speed. Information travels instantly. Geopolitical events, economic data releases, new technologies, they can all send shockwaves through the market in a matter of hours, not days or weeks. Think about the flash crashes, the meme stock frenzy, the rapid interest rate hikes. These are not slow, gradual shifts. They are sharp, sudden movements that can drastically alter your portfolio's allocation in a very short time. This is where the idea of quarterly rebalancing comes into the spotlight. By checking in on your portfolio every 3 months instead of once a year, you become more agile. You have more opportunities to capitalize on market volatility. Let's go back to our 60/40 example. If stocks soar in the first quarter, a quarterly rebalance lets you lock in some of those gains and buy bonds while they might be relatively cheaper. Conversely, if the market takes a sudden dive, you can buy stocks at a discount much sooner than if you waited a whole year. You're essentially rebalancing more frequently, allowing you to react to significant market swings 4 times a year instead of just once. Now, you might be thinking, doesn't that mean more work, more transaction fees, and potentially more taxes? And you're right. Those are the traditional arguments against it. Every time you sell a winning investment in a taxable account, you could trigger a capital gains tax. And yes, there are brokerage fees to consider. Although many platforms now offer commission-free trades, which lessens the concern. But the key question we need to ask is, do the benefits of being more nimble in today's market outweigh these costs? Let's look at some recent history. During the sharp market downturn in early 2020, an investor who rebalanced quarterly in March would have bought stocks near the bottom, positioning themselves perfectly for the rapid recovery that followed. An annual rebalancer might have missed that entire opportunity, waiting until the end of the year when prices were already much higher. Similarly, in a year with intense sector rotation, where different parts of the market take turns leading, quarterly adjustments can help you systematically trim the winners and add to the laggards before the trend reverses. You're giving yourself more chances to stick to that core principle of sell high, buy low. The argument for quarterly rebalancing isn't about trying to time the market. That's a fool's errand. It's about risk management and discipline in a market that moves faster than ever before. When your portfolio drifts significantly from its target, your risk profile changes. If you let your stock allocation creep up to 80%, you're taking on much more risk than you signed up for. A sudden market correction could be devastating. Quarterly check-ins act as a crucial guardrail, preventing your portfolio from drifting too far off track for too long. It enforces discipline more regularly. So, who is quarterly rebalancing for? It is especially beneficial for investors who have a moderate to long time horizon and are comfortable with a bit more hands-on management. It's for those who recognize that market volatility isn't just a risk to be avoided, but an opportunity to be managed. If your portfolio is substantial, the impact of these more frequent adjustments can be quite significant over the long run. The compounding effect of buying low and selling high more often can add up. But what about the annual approach? It's still a perfectly valid strategy, especially for investors who want the simplest, most hands-off approach possible. If you have a very long time horizon, like 30 or 40 years, and you know you're prone to tinkering too much, an annual rebalance might be the discipline you need. It forces you to ignore the noise and focus on the long game. It's also a great starting point for new investors who are just getting their feet wet. There's also a middle ground, a hybrid approach. Some investors use what's called threshold rebalancing. Instead of rebalancing on a set schedule, you rebalance only when one of your asset classes drifts by a certain percentage, say 5% or 10% from its target. So, if your 60% stock allocation grows to 65%, this is a great strategy because it's driven by market movement, not the calendar. You could go a year without rebalancing if the market is stable, or you might rebalance twice in 3 months if things are wild. This method combines the benefits of being responsive without forcing you to trade unnecessarily. So what's the final verdict? In today's high-speed information-driven market, the argument for a more frequent, quarterly rebalancing strategy is stronger than ever. The increased agility it provides can help you better navigate volatility, manage risk, and potentially enhance your returns by creating more opportunities to buy low and sell high. While the traditional annual approach is still fine for the ultra-passive investor, the market environment today rewards those who are just a little more attentive. The speed of the market has increased, and it might be time for the speed of our strategies to catch up. Ultimately, the best strategy is the one you can stick with consistently. Whether you choose annual, quarterly, or threshold-based rebalancing, the most important thing is to have a plan and follow it with discipline. Don't let your emotions dictate your decisions. Let your predetermined strategy guide you. What's your rebalancing strategy? Do you stick to the annual plan, or have you moved to a quarterly schedule? Let me know in the comments below. I'd love to hear how you're navigating these markets. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on smart investing. Thanks for watching, and I'll see you in the next video.